everybody. Welcome to Topics at 12. My name is Diane Sawyer with the Reidsville Chamber of Commerce, and we're excited to continue to bring this COVID series to you, talking about how your business has been affected since the pandemic and continuing after the pandemic. Today is on business taxes, what you need to know. Very important topic. There's a lot of conversation around it, and we're very excited to have Ruben Gonzales with us, who's going to be discussing that. I would like to say thank you to our sponsor, Susan Reagan with the Small Business Center of Rockingham Community College, Team Reidsville, and the Small Business Development Office from Rockingham County Tourism and Economic Development. We're very excited to be a part of this, and before we get started, we are going to turn it over to Roy Sawyers, who is also our producer, with a tech tip from Rockingham Update. Take it away, Roy.
Thank you, Diane. Today's technology tip is 10 ways to use technology in your small business. These tips come to us provided by the Balanced Small Business website. In productivity, use a time tracking software. This is an excellent tool for mapping out where time is spent by whom. Such analysis, when properly utilized, is great for accountability, process improvement, and productivity. It's also recommended to use project management and task management tools to stay on top of your daily business responsibilities. One example is Asana, which I believe is a tool that is being utilized by the Reidsville Chamber. It's designed to help teams organize, track, and manage their work as well. Under financials, use an online invoicing service to reduce the cost of collecting payment from customers. Examples of this would include FreshBooks, SquareUp, and Due, just to name a few of those services. Share digital files with your bookkeeper or accountant to improve your ongoing bookkeeping process. Under marketing, it is recommended to use social media sites like Facebook, Twitter, Pinterest, YouTube, etc. Google Plus is on this list. However, Google Plus is now defunct, as many of us know, so that needs to be removed. Number 6, collect email addresses through an opt-in form and start utilizing the power of email marketing from those opt-in forms. And speaking of marketing, use video marketing. Just like we are doing today with Zoom and these outreach videos, you can reach many more with video. A lot of your social networking sites like Facebook is going to use placement of videos above regular text, status messages and things of that nature. They're really pushing video on their platform. Customer service. Set up an online help desk or ticket system to handle customer issues. Allow clients to schedule appointments online at their convenience. And use online surveys and questionnaires to get customer feedback. Diane, these were the tech tips for today.
Roy, thank you so much. Those are very helpful, and we are excited to see how things continue to develop with some of those, particularly the online invoicing and team project management and social media, because as we all know, the pandemic has proven that there are many things that folks were ahead of the game, but we're all learning new tech tips as we move forward in this virtual and crazy world. So thank you so much. Very helpful. All right, Ruben, we are going to start with your presentation, sir. So please feel free to share your screen with us and we will get started.
Is my screen not already shared?
It is not, because we had to take it off for the other share. So if you will just share one more time with us.
All right. Well, thank you everybody for joining us today. We have several of these in the course of the last couple of months, so only got one or two more to go. So thank you all for showing. Maybe the chamber responds to something in the spring. So yeah, we're going to talk about taxes today. Roy was just talking about wonderful, wonderful types of applications you can get for your phone and other devices that you might have to keep up with your sales, to keep up with your invoicing, to keep up with your sales. And of course, that's very important because In most cases, if you make a sale, and that creates some income for you, and you might owe some taxes. You notice I use the word might. So in today's environment with the COVID virus, for a lot of businesses, it might be relatively close whether you actually have a profit or not. So yeah, we're going to talk a little bit about that today. We only have about 45 minutes, so can't cover this a whole lot. But yeah, we're going to cover some of the important points. So we got a big agenda today. We're going to talk a lot about expenses and so forth and accounting methods. And I'm going to open up a really handy dandy IRS produced publication that you can use as a resource. That's an IRS publication 583. So I will get to that, which is going to help us keep track of everything I'm talking about today. And you can have it for reference later. Yeah, so yeah, a lot of businesses, unfortunately, even though they might not be bringing in a lot of revenue, they're still accumulating expenses. Yeah, that's an unfortunate thing about our COVID-19. We had a little conversation before we started today that a lot of businesses are still doing okay. Fortunately, a lot of businesses are still doing as well. Although if you're in a business that hasn't been doing as well, you're probably wondering, well, what type of businesses are doing as well? So we had several seminars during the course of this series that talked about what you can expect or what you should be doing to prepare for the COVID, what you should be doing to prepare for after COVID, what kind of marketing plans should you be making now with COVID, what type of marketing plan you should be making after COVID, and so forth and so on. So we had a whole series of these seminars. So if you're still stuck with some of those questions, you can get on YouTube through the connection that the Chamber has provided, and you can look at some of those past seminars to show where we have a lot of resources and a lot of tips as far as handling the COVID as far as those overall topics go. But today we are going to talk just about taxes though. So if you have those other questions about some other aspects of the operations, hopefully one of those other recorded YouTube seminars that we had, hopefully they'll help you. Hopefully they'll help you. But yeah, so as I mentioned before, when you are able to look at your sales volume coming in through these wonderful applications. There are other applications, of course, that help you keep track of expenses, and that's kind of really where the trick is for paying your taxes. You have to weigh your sales revenue against your expenses, and what is left over could be the taxable amount for your operation. So you look at this very simple accounting format for all businesses. Income on top, and that's in green, representing cash of some sort. Then you have expenses in the middle in red, because that's where your money goes back out. And then the bottom line is profit. I'm sure you heard that message many times before. The bottom line. What's the bottom? Well, the bottom line is your profit. And you notice I have it in black because sometimes the profit is referred to as it being in the black. You want to be in the black. It's nice to have the green income, and it's nice to minimize the red expenses. But the real deal in business is to be in the black. That's the bottom line, what the profit is. What we're finding today, of course, with COVID is that people do have income, and unfortunately, the expenses are still relatively high, so they're not doing very much in the black. Hopefully, they are at least somewhat in the black, but I'm sure there's a few people that are generating losses as well. So the thing about taxes is you don't pay tax on the income, and you don't pay taxes on the expenses. You only pay tax on the profit. Tax on the profit. It's conceivable, especially nowadays. You might have a quarterly income of $50,000, but you might have quarterly expenses of $50,000. So you actually have a zero profit, which means you for that particular quarter you might have a zero tax liability. For a year, we'll get to the end of the year here in a couple of months. You might have overall income of a couple of $100,000, but if you, in fact, had a couple of $100,000 in expenses, you would have no profit or very little profit, and your tax liability would be very little as well. So again, we don't pay tax on the income or the expenses. What we pay tax on is the profit. But to get to a proper profit calculation, you need to be keeping track of all your expenses. You need to be keeping track of all your income. So when you do subtract your expenses from your income, we have a accurate profit number, and that profit number is what you might be paying taxes on. We're going to talk a little bit later about how people pay taxes in businesses, what type, and that depends on the type of organization or structure you have. But certainly the essence of it is you pay tax on the profit. We are going to use publication 583, and I'm going to get to that right now. I'm going to get off my PowerPoint slide. So if you see the screen change a little bit, don't panic. I'm going to get off my PowerPoint slide, and I'm going to open up this publication 583. It says starting a business and keeping records. Now, even if you're already in business, this is still a handy dandy publication to look at as far as the IRS goes. You know, the IRS wants you to make sure you're doing your record keeping properly so you can pay the proper amount of taxes. So they have some inherent, they see some inherent value in putting out publications like this because they want to make sure you're paying your tax in an accurate, prompt way. So they're in position to collect those taxes. So this is a really good handy dandy publication. You can get on it and download it, keep it for reference and so forth. Yeah, so we're gonna go through here. I'm not gonna go right through every page, of course, but I'm gonna look at it. Just a little bit here on corporations, on other types of business organizational structure. And I am gonna talk about them in terms of how they pay their taxes in a little bit. If you haven't already, you gotta get your taxpayer identification number. I like to say this is kind of the social security number of your business. So it's an EIN number, very easy to get. You can go online and get it. And when you do get it and go through the process, maybe 10, 15 minutes of time. When you get a copy of that, make sure you keep a copy and make sure you make several copies and put them in different places. So don't be like me and you lose your spot. You lose your place where you put your EIN number and now I can't remember it. So it's not like your social security number where you use it every day. So if you do get that EIN number, put it in a safe place, make several copies. So you can get a copy of your EIN number, but it takes forever and it has to be done by mail and they have to send it to you by mail. So it takes a little bit longer than we're all used to in our electronic technology driven world. So yeah, get that EIN number. All right, a couple of things you have to do when you file your taxes. You have to designate a quote unquote a tax year. So what am I talking about? What am I talking about? I'm gonna open up another form. And the form I'm going to open up is a Schedule C. And this particular form is used primarily for sole proprietors, sometimes LLC owners, members who wish to file as a sole proprietor can use this form. Sometimes partnerships use this form as well. But I like to use this form because it's similar to other forms. This is a 2019 form. And I imagine the 2020 form will be very similar. And you can see it's pretty much like we just talked about with our accounting model. We have sales at the top, here we have our income, and then we have expenses in the middle. And this is why I like to use this form. This is a really good demonstration here of about 20 or so fairly commonly encountered expenses when you run a business right here. So I like to use this form. But as we go through, I'll show you other forms like the corporation tax return form. I'll show you the partnership tax return form. And those forms, by and large, when it comes to expenses, they all list relatively the same expenses. So these expenses, quote unquote, are universal as far as businesses go. These are the types of expenses most businesses run into. And I happen to like this form because it sort of lays it out here and really identifiable, really easy to see, and an easy to see format. So I'm going to come back to this in a little bit, but so what are those expenses? What are those expenses? So I have a highlighted here area if I can get to quickly. I'm going to come back and talk some of this other stuff here, but I wanted to talk about this highlighted area here on the right. It says deducting business expenses. So what are these business expenses? We're going to go back to that form. We're going to show you some of the titles of those expenses, but in general, what are business expenses? You can deduct business expenses on your business or personal income tax return, depending on the form of your business. These are the current operating costs of running your business. Say that again, the current operating costs of running your business. This is important because if you're looking at a business that's generating fairly substantial profit, the period in which you have to keep track of this might be a monthly, should be a monthly, and even a quarterly basis. I'll talk a little bit more about this in a little bit, but you might have a tax liability after a period of what we call a quarter, and you might have to pay a tax at that period of time. So for tax purposes, you can't round up everything at the end of the year. You can't round up all your receipts. You can't round up all your invoices that you paid. You can't round up all your canceled check and your check cards at the bank and try to figure it all out at the end of the year. No, the IRS system is what they call a pay-as-you-go system. The IRS system of paying your income taxes is a pay-as-you-go. So whether you're a sole proprietor, a partnership, or some type of corporation, if you in fact have substantial profit at the end of January, at the end of February, at the end of March, you may in fact have a tax liability at that time, and you actually have to pay that income tax. You can't wait till next April 15th. Now, if for some reason you had to wait to next April 15th, there's a possibility you'll get fined a penalty and charge interest on the amount of money you owed for January, February, March. Yeah, so you have to keep up on a monthly basis, certainly on a quarterly basis, to see if you in fact have a substantial profit, which might mean you have a substantial tax liability and you have to pay. What is the tax liability? Well, for different people, it's different things. You know, the corporate tax rate got lowered not too long ago. Depends on what tax bracket you are as far as personal income taxes. But usually you're going to owe somewhere between 15 and 30% is what your taxes are. So, you know, conservatively, you know, you should expect to get hit with a 30%, you know, tax bill. But, you know, depending on what your personal situation look like, it could be down around the 15% level, but it's going to be something. So what does that mean? Well, that means if you happen to have 3 successive months where you pocketed about $10,000 a month in profit, or at the end of that quarter, that 3-month period, you have a $30,000 profit, you might in fact owe somewhere between $5,000 and $10,000 in taxes. So IRS says you can't wait till next April 15th. You have to send that money to the IRS, you know, fairly immediately. Usually by the 15th of the end of that period, the 15th day of the next month at the end of that period. And you do that through an estimated tax payment. I'll talk a little bit more of that when I get to it here in the presentation. But back to deducting expenses. So keeping track of what your expenses are is really important on an ongoing basis. Don't wait till next April 15th. You have to do it. Hopefully you're doing it weekly and certainly monthly, and then for sure you should have a reckoning by the end of the quarterly period. So to be deductible, a business expense must be both ordinary and necessary. What does that mean? Well, here it is. An ordinary expense is one that is common and accepted in your field of business, trade, or profession. Yeah, common and accepted. A necessary expense is one that is helpful and appropriate for your business, trade, or profession. Yeah, this is really key here. This is really actually pretty awesome. So once we get past the common and accepted idea, now we're left with, is the expense helpful? As long as you can show that that expense was helpful in you conducting your business and generating income, then that expense is deductible. That's a pretty wide, low bar. If you could just show that that expense was helpful, and is commonly accepted in your business field, trade, or profession, then that's a legitimate business expense. And I like this last sentence here that's part of this highlighted text. An expense does not have to be indispensable to be considered necessary. It doesn't have to be indispensable to be considered helpful. As long as you can show that that expense helps you conduct business and generate income, then it's a legitimate expense. So I like to use a little example of computers. Yeah, can you run your business without a computer? Right away, everybody says, no, you can't. Well, actually, people have been running businesses without computers for hundreds of thousands of years. Is a computer helpful? Yeah, most definitely. So it's a legitimate expense. So again, it doesn't have to be indispensable. How about two computers? Well, if there's two of you, and maybe two computers is helpful, so that's a legitimate expense. How about three? Well, yeah, maybe if you have one at your house and one in the office and your manager's got one, yeah, maybe three computers are also helpful. How about if you have a sales force of 100? Well, yeah, if it's helpful for your sales force to record sales and submit invoices and so forth and so on, then you could say that even 100 computers are helpful. Now, you can't have 25 computers if you're a one-man operation, right? Because that's a little bit too much. So you do have to be careful in the sense that this is not an open window here. But yeah, I mean, just as long as you can show it's helpful for you. My favorite anecdote for this is somebody I know who's in business down at Lake Norman. He has a power boat that he uses in his business. And right away, people say, well, he must be in the fishing business, or he must be in a tourist trade, or something like that. And actually, he's not. What he is in is a real estate business. He uses that powerboat to take clients out, to show them what their building lot's going to look like from the lakeside. And a lot of the places around Lake Norman, even now, are inaccessible because roads haven't been cut to those places yet. So sometimes the only way to get to those building lots that they're selling for $150,000 is only to get there by the water side. So that's what he uses that powerboat for. Now, he takes advantage of that powerboat on the weekend for his personal use, but the majority of that usage is via his business. So he does get to take the business use of that powerboat as a tax deduction. And actually what he is on is a lease of that powerboat. So he takes about an 80% deduction for business use on that powerboat. So as long as you can show that that deduction is quote unquote, again, if you can show that is helpful, then it's a legitimate deduction. So back to these expenses. Again, this is Schedule C, normally filed with sole proprietorships, but the list of expenses are fairly clear here, and I'd like to use this as a good example. So what are some of these expenses you should be tracking, which are going to allow you to deduct expenses as a whole, which is going to reduce your tax liability. So number 8 is advertising. We all know about advertising. So just about anything you spend on advertising, any types of forms, and in any type of form is a deduction. Now you notice again here, we have two things here. This is a tax form. See this? Number 8 just asks you to put in a number there. Number 9, it's just asking you to put in a number there. These are just the summary total numbers from these expenses. You have to keep the backup stuff, of course. You have to keep all your receipts, all the examples of the advertising you did probably. Yeah, you need to keep all that stuff and add them all up together, and you put the number right here on line 8. You keep the other stuff in your records though, because you might get audited one day, and the auditor, the nice auditor sitting behind the desk is going to ask you, you took $25,000 in advertising expenses? Do you have receipts for all that? And you're going to say, I sure do. And you're going to whip up that, you're going to go to your file and you're going to whip out that envelope and you're going to show him every single receipt you had, which hopefully adds up to that $25,000 you took for number 8 here. So whatever your pile of advertising receipts adds up to at the end of the period, you're going to be recording here in line number 8. Now this form happens to be the end of the period is the end of the year. But as I mentioned, you should be tracking these expenses through a profit and loss statement. You should be tracking these once a month. This form we have here is very much like a profit loss statement. we've got income on top, we got expenses in the middle, and down at the low end here, like on number line 30 down here, we have the net profit. So this is very much like a profit loss statement. All right, line 9, car and truck expenses. Yeah, if the business itself owns if the business itself owns trucks and cars and delivery vans, and you have expenses associated with those cars, trucks, or delivery vans, well, that's where you put them there, line 9. Line 10, commissions and fees. Yeah, if you have some outside salespersons and you're paying them commissions or some types of fees, that's costing you money, line 10, that's where you put that expense. If you actually have contract labor working for you, part-time basis, seasonal people, that kind of stuff, contract labor, line 11, that's an expense. That's just like payroll, it's an expense. You get to deduct that from your income levels. Line 12 is depletion. That has to do with, usually has to do with the forest, land and tree land and that kind of stuff like that. You don't see that a whole lot in the retail sales, but you do see line 13, which is very similar. Line 13 is depreciation. Depreciation. Depreciation is an expense. Depreciation is the expense that you take off a capital purchase. For instance, those cars you're using on line 9, if you have a car that the business is purchasing, or maybe the business has already purchased it, but it has some useful life, that car. It might have a useful life of 7 years. If it's a big truck of some sort, it might have a useful life of 10 years. Other capital purchases that you might buy, like furniture and so forth, they might have a shorter useful life, maybe 3 years to 5 years. All capital purchases that have a useful life that extend beyond 1 year are depreciated over time. So what does that mean? Let's take that car again. So you bought a truck, say, you bought a delivery van for your business and it cost you $25,000. Well, in simple math, if the depreciation schedule for that asset was 5 years, you would be deducting $5,000 a year for 5 years. Depreciation allows you to deduct the useful use up of the useful life of a capital asset, but it has to be extended beyond the 1 year that you bought it in. Again, our nice, handy publication has a whole section on depreciation. So let me see if I can find that for us. Excuse me a second while I look through here pretty quickly here. Nope, I missed it. I apologize. I might have to go higher. I was thinking it was lower. I'm passing by a couple other things here that are going to be interesting that I'll come back to in a little bit, but oh man, I missed it again. So I'm just going to keep talking. So yeah, depreciation is the use up of an asset over a period of time. Some things you deduct in the first period that you buy them, in the first year that you buy them. You know, like if I had a restaurant and I had a bunch of plates and silverware, I would deduct those things basically at the time I bought them. If I had more sturdy stuff, then you have to take the depreciation of that over time. So here's the depreciation explanation right here on this in this publication. If property you acquire for use in the business has a useful life that extends substantially beyond the year and it is placed in service, you generally cannot deduct the entire cost of a business expense in the year you acquire it, in the period you would acquire it. You must spread the cost over more than one period and deduct part of it. You can't deduct it all in that first period. This method of deducting the cost of business property is called depreciation. Depreciation. But depreciation is used in our example here. Depreciation is used right here in line 13. So once you come up with that number, you're going to stick it right here in line 13. But it didn't cost you really any money at that moment. It's money you spent previously when you bought that capital investment, but you get to deduct that off right here. Now remember, if you spent $25,000 cash on that delivery van, and that first year you bought it, you cannot take the whole $25,000. You have to spread the cost over that over a longer period of time. So what are these times? What are these times we're talking about here? Well, hang on a second. As everything with the IRS, there is a form, there's a publication, there's a booklet out that will actually show you what the different depreciation schedule are. And here's the book. Here's the booklet. Publication 946, How to Depreciate Property, right? Well, you know, it's over 100 pages long. So we're not going to go through here page by page today. So, but it's available for you. So if you want to find out specifically exactly what the depreciation is on a particular piece of property, there it is, publication 946, and that'll show you. Now, if most of us, as in most of us, a lot of us should, if you have a tax accountant that's doing your taxes, they'll know what the depreciation is. They'll know what the depreciation is, so they'll be able to figure this out for you. But this can get pretty complicated, especially if you have a lot of equipment. If you have a lot of equipment, if the company has a lot of equipment, it owns several backhoes, a lot of construction companies face this all the time. Every time you buy one of these pieces of equipment, it goes into the form, and you have to keep track of what the depreciation is as you move forward during the course of the tax year. So anyway, there's a bunch of other things here. Insurance is deductible, interest, so forth, legal and professional fees, office expense, property, pieces of equipment you might lease or property you might lease, repairs and maintenance, travel. There was a publication here I have out here on travel expenses and that kind of stuff. Yeah. Sorry. So yeah, you want to be sure you get the different types of publications to make sure you have the right one. Here's something for excise taxes. That's for people who are selling things like kerosene and gasoline. They have to pay excise taxes on. And here's a whole booklet as well on deducting travel, gift, and car expenses. So yeah, a booklet for everything from the IRS. Why? Because they want to make sure you're accounting for your expenses properly. So they want to make sure you're accounting for your taxes in the same proper way as well. So this is the Form 1120, which is actually the U.S. Corporation Income Tax Form. And you can see here, just like I mentioned, you have income here in section 1, just like the profit loss statement, just like that Schedule C. And we have expenses here in the middle, just like that profit loss statement would have, it's just like that Schedule C had, so forth and so on. So yeah, you can deduct all these things as well if you're in a corporation structure. Corporation structure also has, as most businesses, you're able to deduct bad debts as well. Bad debts as well. So yes, a form for every season, so to speak, but you'll find that most of the forms are arranged in a similar way. I think the last form I might have here might be the form for partnerships. So this is the partnership form. And as you can see, it accounts for income and deductible expenses in the same way the other forms did. So whether you're a sole proprietorship, whether you're a corporation structure, or whether you're a partnership, you're going to account for your income, expenses, and profit in the same way. And again, you'll be paying your taxes based on your profit. Most of the forms has this section up here on the information section, contact information sections, where you have to account for your accounting method as either a cash method or as an accrual method. What does that mean? Well, I'm going to get that up on the form here to show you, but what that means is that on the accrual method of paying your taxes, you account for the income or you account for the expense at the time the expenses incurred or at the time the profit is earned. So you do have to think about this a little bit. I'm going to take a stab and say 98% of all businesses use the accrual method. What does that mean? Again, you account for the expense or the income incurred or earned in the period when it happened, not when it got to the bank. That's the easiest way to say it. So if you paid an expense late in the month or late in the year, but the person you paid it to didn't actually cash that check until the following period, you would still account for that in the period in which the expense was incurred. That's the accrual method. The cash method says you wait for it to get to the bank. You wait for it to get to your checking account, your business account. But that's not really an accurate way to do it. You have to account for the expense, or you have to count the revenue earned in the period it happened. You don't wait around for it to get to your bank. Waiting around for it is not really very accurate. For instance, let's say you were ready to pay rent and you gave your landlord your rent check towards the middle of the month, and he put it in his pocket and he forgot about it and didn't get around to cashing it until the following month. Does that mean you got free rent that month? Because it's not going to show up in your profit and loss statement if you're using the cash method. It'll only show up in the profit and loss method if you're using the accrual method. So again, the accrual method means that you have to account for the expense or account for the income earned in the period it actually happens, not waiting around for it to clear the bank, which could be several days or even a period later. And you have to make this election. And you saw there in that one tax form I showed you, yeah, you have to make this election. You also have to make a designated tax year election. So most people, again, most businesses use a calendar year, January through December. Some institutions use a fiscal year, which is usually July 1 through June 30th. A lot of public institutions and government institutions use a fiscal year, but most businesses use they designate a calendar year, and that's generally speaking the best way to do it. Again, ends up being the most accurate. If you actually change your accounting method, you actually have to let the IRS know. So start off on a good foot, use the accrual method, and you'll be okay. Here's that information I mentioned here. The IRS is a pay-as-you-go tax. So you got to be ready to pay these taxes on an ongoing basis. So because of that, you have to get monthly profit loss statements. Because as I said, if you start earning actual profit, you have to make what's called this estimated tax payment. And again, this happens to do with the tax year, but you have to account for your profit on a monthly basis because generally you must pay taxes on income by making regular payments of estimated taxes during the whole year. Now, we used to call these in the old days quarterly tax payments, but actually they don't quite line up anymore for quarterlies. I think it's the second period of tax payment. I think it only goes 2 months. So you have to be ready for that. But we used to call them quarterly, but they're not called quarterly now. They're just called periodic tax payments. And they're made 4 times a year. They're made at the end for the first quarter, January, February, and March. Then the second period, April and May. Then the third period, which ends in September. And then the fourth period, October, November, December, you have to make that tax payment, estimated tax payment. You get a chance to make that before January 15th. Now, with the COVID pandemic we had last year, several of these different types of tax payments were actually deferred for some time. For instance, if you owed an estimated tax payment in January, you were allowed to defer that for a period of time. If you owe taxes, you all remember, if you owe taxes by due April 15th, you were allowed to defer that payment to July. Excuse me, the estimated tax payment actually was the one that was due for the first period, which was due April 15th, the same time taxes are usually due. Both those taxes, the estimated tax payment due in April and your regular taxes that were due in April, they were deferred until July of this year, 2020. I'm not sure that anybody knows what next year's taxes are going to look like. No one knows if we're going to get another deferral of these payments and so forth. So you should go on the assumption we're not going to get any types of deferrals, and you should be keeping up with your taxes right now, 4 times a year, roughly a quarterly basis, so that you could be prepared to pay your taxes. You know, if you owe $5,000 in taxes each period, 4 periods, $20,000 total, come next April 15th, it'd be pretty tough to write a check for $20,000. I don't know many people who can write a check for $20,000. It's a lot easier if you were to send them $5,000 every so often. You know, $5,000 in the March, $5,000 in the May, $5,000 in the September, and $5,000 early in January. And you have all that money on account, so to speak. Then April 15th, when you find out your total tax bill is, you already would have paid in that $20,000. So hopefully that would be enough to cover all your taxes. But if not, it would be a lot easier to write another check for $2,000, $3,000, $4,000 than it would be to write a check for $23,000, $24,000, $25,000. So keep up with your profit, because you may have a tax liability and the IRS says you have to pay that as you go, young man. You cannot wait till next April 15th to make that payment. There are a few other things here. It's not a tax course here. I just want to keep you involved in the main points of taxes for small businesses, but I'm sure unless you have a really, really low income generating business, you probably be using a tax accountant to get your tax work done. So they're going to know all these tricks. I'm just asking you to be prepared on a regular basis, because you might have to make these estimated tax payments. There are penalties, so you don't want to get stuck in a penalty situation. A lot of people use a use of their home if they have a home office. That's a deduction. I use one here in my little house. I've got a room in the back that I use predominantly for business purposes, and there's a little deduction on that as well. Business use of your home office, that has to be specifically for your business. It also has to be the only office. You can't have an office in town and an office in your home. You can't take the deduction for both. You get one or the other. That's what it says right here. This has to be your principal place of business. So yeah, it's a good deduction. So you have an opportunity to look at those. You notice that many times when you work your way through this publication here, there are other publications that the IRS asks you to review. So for this specific use of your home, there's a whole other publication on that as well, to make sure if you're doing it yourself, make sure you're getting it right. Car and truck expenses are legitimate deductions for your business, like my friend that has that boat he uses, or businesses that have delivery vans. So there are car and truck expenses you can take as well. And you can take the business use of your personal vehicle as a deduction as well. The way that usually works, you calculate what those personal expenses are, and then when you file your own income tax forms, you include those forms, the deduction on your personal income taxes, and you get a tax break. You get a tax break for those car and truck expenses when you're using your own personal vehicle. Of course, remember, if the business itself owns a vehicle, it's already taken the deductions. It's an expense to own that vehicle. So the vehicle payments, the gas and tires that go in that vehicle, all that stuff is being deducted currently by the business. But if you're using a personal vehicle in the business, then you can use whatever expenses that are incurred by that personal vehicle. You can use those expenses to lower your own personal income tax liability. All right. That's pretty much it for the deductions and expenses. I'm going to close. We're going to save a little time later for some questions, but I want to close by showing you this, how long to keep records. This is an interesting table here. It's called the period of limitations for filing taxes. And of course, this is pretty much like the IRS. It's a little bit confusing, but number one, if you owe additional taxes and situations 2, 3, and 4 below do not apply, the limitations are 3 years. I mean, the IRS can go back 3 years. They won't go back too much further than that. You know, if you're just making a small mistake, you got a little business, no big deal. You know, 3 years, you're good. But however, if the IRS determines that you have the income that you should have reported, and it's 25% more than the gross income you did return, the IRS can go back 6 years. Why is the IRS going back so far? The IRS is going back far to see what you were doing those other 6 years. I mean, if you made a mistake right now, and it's a substantial mistake, which is evaluated based on this 25% of gross income, the IRS probably figures you've been cheating all along, and they're going to go back another 5, 6 years and look at your other tax returns. So if you've been making the same mistake pretty regularly for the past 5 or 6 years, you could be in a heap of trouble. So don't let that happen. And if the IRS finds out and determines that you actually did number 3 here, you filed a fraudulent return, what does it say for the time limit? There is no limit. They go back as far as they want. They go back 10, 15, 20 years. So you could have 20 years worth of tax returns pulled, and the IRS will examine those to see if you've been making the same types of mistakes year after year after year. And if you have, that's going to be quite a hefty penalty that you're going to pay. Plus you owe all the interest and you owe the taxes that you should have been paid back then. So don't let that happen. Keep up with your taxes. Don't let the pandemic slow you down. If you have a loss, here's the wonderful thing. If you have a loss, you actually can take that loss on your taxes, So keep up with what's going on in your business. If you happen to have a loss, here it is right here, line 31. It says this in all the forms. It's a profit or a loss. A profit or a loss. Then you can take that loss deduction on your taxes as well. So that's the good news about having a loss. A good part of it could be deductible. So here it is again. If the income when compared to expenses is less and you have more expenses and you actually generated a loss, then you could take a loss on your tax returns. That might help you save on other income you have coming into your household situation. And it might be a loss you'll be able to roll over to subsequent years coming up, which would be a good thing as well. Just real quickly here, I have about a minute to go. I wanted to show you on these different forms of organizational structures. Sole proprietorship here, partnership here, corporation, S corporation, and a limited liability company. Depending on what organization or structure that you put together, that's going to determine how you pay your taxes. For instance, in a sole proprietorship, if the business has profit, it goes to your personal 1040 and you pay the taxes. If you're in a partnership and the business has profit, it goes to each of the partners 1040 and they report it and they're responsible for the taxes. If you're a C corporation and the corporation makes a profit, and a C corporation, the corporation pays the taxes. If you're in an S corporation and the S corporation makes a profit, that profit flows through to the shareholders. And the shareholders are responsible for the tax liability. And on a limited liability company, if the limited liability company makes a profit, that profit flows through to the members, and they're all responsible for reporting the income on their individual 1040s. So in almost every sense, if there's profit made in the business, it's going to find its way to your individual 1040, and you're going to be responsible for paying the tax. The only exception is the corporation. If the corporation pays taxes, if the corporation has a profit, then the corporation pays the taxes, not the stockholders. And anybody who's owned stock knows that. If the corporation makes a lot of money, you don't get a tax bill. The corporation did, but you did not. All right, that's a quick tour of paying taxes. This is a short 45 minutes. Usually when I do this seminar, it takes me, I get 2 hours to do it in. So if I've missed anybody has questions, we have an opportunity right now. And if not, you can always contact me. Here's my email address, businessplanforstartup@gmail.com. You can send me an email and I'll be happy to respond to any of your simple tax questions you might have. All right, Diane, I think that's it.
Ruben, that was awesome. I know we're going to have a lot of folks who are going to want to watch this later, and we've had some requests for the slides, so I'll get with you about that. I do not have any questions in the chat box. Does anybody have any questions that they would like to unmute themselves and ask of Ruben?
Did you just say that this would be available to watch again, listen to again? Okay.
Yes, so the Reidsville Chamber, if you go to reidsvillechamber.org, and I can send you the link in the chat, but there is a Topics at 12 tab, and all of our previous ones are there as well. And when this one's available, it takes sometimes a week or so on average to get these back. Rockingham Update produces them. So it'll be on the Reidsville Chamber Facebook, and then it'll be on our website as well. And you can look back through all of the library. We've put them all there. So some really good information.
Thank you.
You are so welcome. Did you have any specific questions about today?
Oh no, a lot of great information. It's just, that's the thing, it's a lot of information, so it takes a little bit to digest and really make sure getting all the going into the minutia of all of it.
Sure, and a lot of times stuff's individualized, and we get that too. So
Exactly.
Ruben and myself and Susan, we're all available if you need us for anything. So the contact information will be on the slide set that we email.
Thank you so much.
You are welcome.
Yeah.
All right, anybody else? All right, well then I guess we will close it out. Thank you everybody for joining us. Thank you, Ruben, for such a great presentation.
All right.
Join us next week as we have a new topic. So we'll see you all soon.